Hello everyone, welcome to this episode of Financial Science Popularization. At the start of 2026, Bitcoin fluctuated around the $90,000 mark, briefly surging to $94,000 in the first week before quickly falling back to around $93,000. Some say the wave of interest rate cuts will trigger a new bull market, while others warn of the third-year curse of the halving cycle. Today, we'll break down this complex issue and discuss the underlying logic of Bitcoin's market in 2026 from four core dimensions, helping you understand where the opportunities lie and where the risks are. To judge the Bitcoin market trend, first look at the global monetary environment. A key change in the macroeconomic environment in 2026 is that quantitative tightening has ended, central bank balance sheets are growing again, and the market widely expects the Federal Reserve to continue cutting interest rates. Goldman Sachs even predicts that a cooling job market may force the Fed to implement more aggressive interest rate cuts. For Bitcoin, considered the ultimate risk asset, this is a significant positive lower interest rates, a weaker dollar, and more abundant global liquidity make it easier for funds to flow into highly volatile assets like cryptocurrencies. However, there is an uncertainty. The next Fed chairman has not yet been chosen, and the new chairman's policy inclinations will directly affect the pace of easing, which is a variable we need to continuously monitor. In addition, geopolitics is also quietly exerting its influence. For example, news that Venezuela uses USDT to settle 80% of its oil export revenue and is suspected of holding a $60 billion Bitcoin treasury has brought more attention to Bitcoin's non-sovereign asset. Attributes. When discussing Bitcoin, the key pattern of the halving cycle is unavoidable. Bitcoin halves every 4 years, reducing the block reward by half. Historically, the first two halvings have been followed by a bull market roughly a year later. However, the third halving didn't immediately deliver on expectations. Instead, it experienced significant volatility. More importantly, 2026 falls in the third year of this halving cycle. According to research by Charles Schwab, Bitcoin typically performs poorly in the third year of a halving cycle, and many investors follow this cycle's theoretical patterns, potentially suppressing prices. However, it's crucial to note that history doesn't guarantee future results. Current market institutional participation, liquidity conditions, and the overall halving cycle are different from previous ones, so past experiences cannot be simply applied. 2026 is a pivotal year for global crypto regulation, directly impacting the pace of institutional investment. The most crucial element is the US Clarity Act, which enters its critical revision process on January 15th. If passed smoothly, it will clarify the classification of crypto assets like Bitcoin, define the regulatory responsibilities of the SEC and CFTC, provide the industry with stable expectations, and potentially accelerate institutional investment. However, institutional actions are divergent. On one hand, Morgan Stanley is applying for a Bitcoin-related ETF, PwC is increasing its investment in crypto businesses, and MSCI has suspended its plan to remove digital asset reserve companies. On the other hand, the initial flow of funds into Bitcoin ETFs at the beginning of the year was quite contradictory. Net inflows of over $1 billion in the first 2 trading days were followed by net outflows of $1.128 billion over 3 consecutive days, almost erasing the year's gains. This suggests that institutions are still adopting a tactical approach, lacking firm confidence. It's also important to note that regulations vary significantly across different regions. The EU's cryptocurrency tax transparency law has come into effect, requiring transaction data to be shared with tax authorities, while China continues to strengthen its regulations, explicitly cracking down on cryptocurrency trading and speculation. This is a risk point that global investors should pay attention to. Taking all factors into account, the Bitcoin market in 2026 is likely to be cautiously optimistic, but a repeat of the retail-driven surges of the past is unlikely. Schwab's research points out that while short-term factors such as interest rates and liquidity are favorable this year, Market sentiment in the third year of the halving cycle is suppressing Bitcoin's gains from its year-to-date lows, potentially falling far short of the historical average of 70%. Two key points to watch. First, the progress of the US Clarity Act in mid-January, and second, whether Bitcoin ETF fund flows can continue to recover. If regulations are finalized and institutional funds continue to enter the market, it could drive a steady upward trend. However, if macroeconomic easing falls short of expectations, or if black swan events such as escalating geopolitical conflicts or tightening regulations occur, the $90,000 mark could face significant pressure. Finally, it must be emphasized that cryptocurrencies are not legal tender and have no credit backing. China explicitly prohibits cryptocurrency trading and speculation. Trading in cryptocurrencies carries multiple risks, including volatile prices, platform collapses, and fraud. Our market analysis is intended to educate the public about market logic, not to recommend investments. Always respect the market and protect your principal. Regarding the Bitcoin market in 2026, are you optimistic or cautious? Do you think regulation will be the biggest variable? Feel free to leave your opinions in the comments section. If you want to understand the underlying logic of a particular type of cryptocurrency, you can also type it in the chat. If you liked this content, please like and follow so you don't get lost. See you next time for more educational content.